$42 billion left a single bank in fewer than 24 hours. Not because of fraud, not because of a cyber attack, because a few thousand people read something on social media, opened their banking application, and pressed transfer. That is how one major California bank collapsed in March of 2023. And here's a figure the FDIC does not advertise on any billboard. At the precise moment that institution failed, the entire deposit insurance fund contained enough money to cover roughly $1.28 for every $100 of deposits it was legally obligated to protect. Not $100, $1.28. That ratio has improved since then. It currently stands at $1.42. You can decide for yourself whether that adjustment changes anything meaningful about your weekend. So the real question is not whether the FDIC fund could become exhausted. The real question is what happens the morning after that occurs. And the answer runs through a sequence of legal mechanisms, political judgments, and institutional backstops that most Americans have never read about. Largely because those documents were not designed to be easily discovered. Here is exactly what will be covered today. The FDIC is not a vault sitting somewhere filled with your money. It is a coverage ratio, a borrowing arrangement, and ultimately a congressional phone call. Those three things are very different instruments when a crisis is accelerating faster than the people responsible for managing it can respond. The goal is to show you how the underlying mathematics actually function. What happened during the two previous occasions when the fund went completely dry, what the legal escalation sequence looks like when it exceeds the fund balance, and what three specific actions you can take right now that cost nothing and eliminate the most dangerous failure scenario you face personally. All three actions will be provided before this ends. Here is the analogy that will thread through everything discussed today, because it happens to be almost uncomfortably accurate. Think of the FDIC as a fire insurance company serving your entire neighborhood. It collects premiums from every house on every street every single month. It maintains a reserve fund, sized to handle an occasional fire, perhaps 2 or 3 homes burning simultaneously. Right now, that reserve covers $1.42 for every $100 of property value it is insuring. Your neighbor's house catches fire. No problem. 2 houses on the same block ignite at once. Still manageable. But if the entire street catches fire on the same Tuesday afternoon, the insurance company burns through its reserves before the fire trucks have even left the scene, and then it draws on its credit line. After the credit line runs out, it goes directly to knock on the Treasury Department's door. This is not a personal interpretation of events. This is the documented escalation sequence written into the Federal Deposit Insurance Act, word for word as it exists in the statute. Call this the coverage ratio problem. Hold that phrase close. Every revelation in this discussion runs directly through it. In a few minutes, a legal mechanism will be explained that was actually deployed in 2023 to rewrite the operating rules of deposit insurance in real time while markets were closed and most of the country was asleep. But first, here is why the baseline mathematics should concern you even on a completely ordinary Tuesday with no crisis in sight. The Deposit Insurance Fund, as of the fourth quarter of 2025, held $153.9 billion. That is the official published FDIC figure. The FDIC insures over $10 trillion in deposits. $10 trillion. The coverage ratio sits at 1.42%. The FDIC's own internal target, the number the agency has been working towards since 2020, the figure they regard as the minimum necessary to survive a crisis of the scale of the 2008 financial collapse, is 2%. They are not at their own target. And that target, according to their own documented analysis drawing on historical data spanning 1950 through 2010, represents the floor of what would be required to maintain a positive fund balance through a repeat of the worst financial crisis the institution has ever confronted. In other words, the FDIC right now, by their own internal mathematics, is underfunded relative to what they calculated they would need to survive the previous crisis. Not the next hypothetical one. The last real one. Now add the figure that never makes the headline. Approximately 43% of all bank deposits in the United States are uninsured. That statistic comes from the Federal Reserve Bank of St. Louis, published in April of 2026. In raw dollar terms, as of the second quarter of 2025, total uninsured deposits equaled approximately $9 trillion. Insured deposits equaled $11 trillion. The 1.42% coverage ratio applies to that $11 trillion. The $9 trillion sits entirely outside FDIC protection under the law. Most of the people holding those uninsured balances believe they are covered. They are not. JP Morgan Chase alone holds an estimated $1.2 trillion in uninsured deposits. One institution. That single figure is roughly 8 times the size of the entire deposit insurance fund. The coverage ratio problem is not simply that the FDIC might lack sufficient funds to cover insured depositors in a crisis. The actual coverage ratio problem is that the FDIC is being informally expected to backstop $9 trillion of deposits sitting above the legal insurance limit, using a fund that covers 1.42% of the $11 trillion that actually fall within that limit. There is someone worth describing here. He operated a modest manufacturing business outside Phoenix. 12 employees. Nothing complicated, primarily commercial HVAC components. His business checking account regularly held between $350,000 and $400,000 because his payroll cycles ran quarterly, material invoices arrived continuously, and a 60-day receivables lag meant he was always carrying a significant cash float. He had the sticker on the front door, FDIC insured, member bank, the complete assurance. He assumed he was fully covered. $250,000 of that balance was covered. The remaining $130,000 placed him legally in the same position as an unpaid vendor the moment the bank closed. He was an unsecured creditor. He simply did not know it until someone explained it to him directly. The gap between what people genuinely believe the FDIC covers and what it actually covers under the law is not a minor footnote issue. It is a financial planning failure, and it scales proportionally with how much money a person has at risk. The FDIC's own problem bank list as of the second quarter of 2025 contained 59 institutions. Banks carrying what the agency describes as significant financial, operational, or management weaknesses that place their continued viability in serious doubt. The FDIC characterizes that as the healthiest the list has appeared since 2022. 2 banks have already closed in 2026. The suggestion here is not that the system is on the verge of collapse. The suggestion is that 59 banks are on a confidential watch list the public cannot access, monitored by a fund holding 1.42% of what it is legally responsible for protecting. Stay with this, because what comes next fundamentally changes the frame of everything discussed so far. Shortly, the exact mechanism by which the government rewrote the coverage rules during the 2023 crisis in real time will be explained, using a legal provision most people have never encountered. But first, something needs to be established that has been quietly removed from most people's understanding of how the FDIC actually functions. The fund has gone negative before. Not theoretically, literally twice. The first instance was 1991. The savings and loan crisis had been grinding through the American economy for the better part of a decade. The FDIC fund peaked at just over $18 billion in 1987. Then a wave of commercial bank failures compounded on top of the broader thrift disaster. The fund balance sank into negative territory on an accounting basis, reaching negative $6.9 billion. The fund that existed to guarantee your deposits was operating in the red. Congress quietly restructured the approach. The FDIC borrowed through the Federal Financing Bank, and depositors never lost a single dollar. But the fund itself was gone. On the thrift side, the situation was even more severe. The Federal Savings and Loan Insurance Corporation, the agency that insured savings and loans in the same way the FDIC insures commercial banks, was estimated to be insolvent by approximately $75 billion in 1988. The entire agency ceased to exist as a functioning entity. The Resolution Trust Corporation was established specifically to manage the resulting wreckage. The RTC ultimately closed 747 savings and loan institutions, holding assets exceeding $400 billion. The total cost to taxpayers was estimated as high as $124 billion, with that figure confirmed by 2004. The FSLIC's remaining obligations were absorbed into the FDIC because nothing remained of the FSLIC worth absorbing. The second instance the fund ran dry was between 2008 and 2009. From 2008 through 2017, 528 member institutions failed. The annual peak reached 157 failures in 2010. The insurance fund was exhausted by late 2009. The FDIC demanded 3 years of prepaid premiums from member institutions and operated with a negative net fund balance, reaching negative $20.9 billion at the close of 2009. Here is the detail almost nobody discusses regarding that episode. The FDIC possessed a credit line they could have drawn upon immediately. They chose not to, specifically because of how it would appear publicly. An FDIC director addressed this directly in 2013 in straightforward language. Drawing on a Treasury borrowing line would have been perceived as a bailout, even though the borrowing would have been fully repaid with interest. So rather than utilizing the legal mechanism available to them, they extracted prepaid premiums from banks that were already under strain and ran the protection fund negative. Political optics managed as though it were prudent financial stewardship. That is the coverage ratio problem manifesting in real time. The backup mechanism is not automatic. It requires a deliberate political decision, and political decisions made during financial crises carry enormous pressure and enormous incentives to avoid anything that resembles a bailout, even when it technically is not one. Now here is why 2023 represents a structurally different and more instructive story than either of those two prior examples. It involves a legal exception embedded in the Federal Deposit Insurance Act that, when invoked, effectively rewrites the coverage rules in the middle of an active crisis. But a critical subplot needs to be established first because it permanently altered the underlying physics of how all of this operates. In March of 2023, analysis posted online combined with a coordinated group conversation among venture capital investors helped ignite one of the fastest bank runs in recorded American financial history. $42 billion in withdrawal requests hit Silicon Valley Bank within a single 24-hour period. The institution carried $172 billion in deposit liabilities, and 89% of those deposits exceeded the FDIC insurance limit. When information spread that the bank was sitting on substantial unrealized losses in its bond portfolio, the depositors holding uninsured balances, who possessed every rational incentive to exit first, exited first. Within 48 hours, documented researchers using high-frequency payment data confirmed that contagion had spread to 22 other banks simultaneously. The FDIC's crisis response architecture was built in 1933. The platform that accelerated this crisis launched in 2006. The FDIC's operational framework was constructed around the assumption that a bank run looks like depositors forming a physical line outside a branch location. It now looks like a group message thread. That is the speed problem. It threads through everything that follows. Now, the systemic risk exception. When the California Bank failed on a Friday in March 2023, the FDIC, the Federal Reserve, and the Treasury Secretary jointly activated a provision written into the Federal Deposit Insurance Act, permitting them to override the standard cost minimization requirements. Under ordinary circumstances, the FDIC resolves a failed institution in the least expensive manner available. Locate an acquiring bank, transfer insured deposits, allow uninsured depositors to pursue whatever recovery they can through the asset liquidation process. That is the statute. That is the default operating procedure. The systemic risk exception states that if regulators determine that following the default process would produce serious adverse effects on overall economic conditions or broader financial stability, they may override the standard rules and protect all depositors regardless of balance size. No ceiling, the complete deposit book. Invoking that exception at SVB cost the Deposit Insurance Fund an estimated $20 billion. $18 billion of that went directly toward covering deposits that were legally above the insurance limit. Deposits the FDIC was never statutorily required to protect. The FDIC subsequently issued a special assessment against 114 large banks to recover those costs. Institutions that had absolutely no involvement in SVB's failure paid to make SVB's depositors whole. This arrangement creates what is arguably the most underappreciated dynamic in American deposit insurance. If the systemic risk exception is activated every time a large institution fails, and recent precedent strongly implies it will be, then the effective coverage threshold of the FDIC is not $250,000 per depositor. It is unlimited for banks large enough to pose credible contagion risk. The $250,000 limit functions as a guaranteed floor for smaller depositors and as a negotiating baseline for everyone else. Former FDIC Chair Sheila Bair addressed this directly in public statements following SVB. She argued that invoking systemic risk protection for an institution representing less than 2% of the total banking system established deeply problematic precedent. She was not wrong in that assessment, which means the coverage ratio problem is substantially more severe than the headline figure suggests. The fund holds 1.42% of insured deposits, but that same fund is now informally expected to cover a meaningful portion of $9 trillion in uninsured deposits whenever regulators determine that the systemic risk exception is warranted. The actual ratio of fund balance to realistic expected exposure, if you incorporate the anticipated coverage of uninsured depositors at systemically significant institutions, is a number the FDIC does not calculate publicly. The reason for that omission is not difficult to understand. Let a concrete scenario make this tangible rather than abstract. You are a business owner. Your company's checking account holds $380,000 this week. A substantial payment from a large client just cleared. Payroll runs in 10 days. $250,000 of that balance is federally insured. The remaining $130,000 is yours in roughly the same sense that a seat on a bus is yours after the bus has already departed without you. In the most common resolution scenario, the bank is acquired over a weekend by a financially healthy competitor. You log in Monday morning, the balance is identical, the routing number has changed, and the entire episode disappears from your awareness before it becomes a news story. This is precisely what occurred in the vast majority of the 528 bank failures between 2008 and 2017. Quiet, operationally seamless, completely invisible to depositors. But in the scenario where no acquiring institution steps forward, which is exactly what happened with SVB, requiring a bridge bank structure and 16 days of uncertainty before an eventual acquirer absorbed it, here is what happens to your $130,000. You become an unsecured creditor of the failed institution. You file a claim with the FDIC receiver. The FDIC proceeds to liquidate the bank's assets over an extended period. Your ultimate recovery rate depends entirely on the quality of those underlying assets. When one institution failed in 2008, uninsured depositors recovered approximately 50 cents on the dollar. When Washington Mutual failed that same year and was immediately acquired by JP Morgan Chase, uninsured depositors recovered their complete balances because the acquiring institution assumed all deposits. The variance between those two outcomes is enormous and essentially impossible to predict in advance. The actual failure mode worth focusing on is not permanent loss of funds. Permanent losses are genuinely rare. The real failure mode is temporary inaccessibility of funds at the precise moment those funds are most critically needed. Your insured $250,000 arrives within a few business days, sometimes the following morning. The $130,000 enters a legal queue with an indeterminate timeline. Payroll still hits in 10 days. You violate your payroll obligations on day 11. State labor enforcement agencies are not interested in your FDIC receivership timeline. Vendors begin pulling established credit lines. The business you constructed over 12 years begins to disintegrate, not because your money disappeared permanently, but because it became legally unavailable for long enough to trigger a sequence of operational failures that no eventual recovery can reverse. This is why cash management structure deserves genuine attention. Not because bank failures are likely on any random Tuesday, but because the failure mode is profoundly asymmetric. The upside of having your cash correctly positioned is zero additional investment return. The downside of having it incorrectly positioned is a liquidity crisis that strikes your most critical financial obligations at the worst conceivable moment. Here is what actually happens legally and sequentially when the fund runs out. The FDIC maintains a $100 billion credit line with the United States Treasury. This line has never been directly drawn upon, not once in the entire history of the FDIC. The agency also maintains a separate $100 billion facility with the Treasury's Federal Financing Bank, which it utilized during the savings and loan cleanup, borrowing $15 billion in the early 1990s and repaying it fully by 1993. In 2023, the FDIC borrowed $93.3 billion across 5 separate notes through the Federal Financing Bank in connection with the resolution of that spring's bank failures. $93 billion in emergency borrowing against a fund that held approximately $128 billion at the start of that episode. 3 large bank failures. $93 billion in emergency financing. 3 institutions out of more than 4,000. If the existing borrowing capacity proves insufficient, the law permits it to be expanded. During the 2009 financial crisis, Congress temporarily authorized the Treasury Secretary to extend FDIC borrowing authority to $500 billion, subject to Federal Reserve Board and presidential approval. This is the actual backstop. Not the fund itself. The backstop is the government's capacity to issue a sufficiently large check and subsequently determine who gets assessed or taxed to retire it. Full faith and credit is not a representation that money currently exists. It is a commitment that money will be created or collected if it does not. But this is precisely where the speed problem becomes the determining variable. The fund running out is not a single moment in time. It is a process with a duration. Between the moment the fund is exhausted and the moment the Treasury backstop materializes, bureaucratic procedures must run their course. Conversations must take place. Political calculations must be made. The same optics-driven hesitations that prevented the FDIC from drawing the Treasury line in 2009 will be present again. During that interval, the news cycle is running continuously. Social media is running continuously. Digital banking is running continuously. The bank runs that caused the fund to deplete in the first place are accelerating in real time because the mechanism that stops bank runs is confidence. And confidence depends on a credible announcement that the situation is fully contained. That announcement must come from a credible institution supported by a credible fund. And a credible fund, by the FDIC's own internal analysis, requires a 2% reserve ratio. The current ratio is 1.42%. This is what transforms the coverage ratio problem from a purely mathematical issue into a confidence problem as well. The fund does not need to reach 0 for confidence to fracture. It needs to be perceived as potentially insufficient. And the perception of insufficiency can arrive well before the arithmetic reality does. What is genuinely fascinating about this dynamic, in a somewhat uncomfortable sense, is that the FDIC's entire communication strategy is calibrated specifically to prevent people from engaging seriously with the analysis just presented. Not because this information is classified or hidden from public access, because serious public engagement with it produces the exact outcome the FDIC exists to prevent. Confidence in deposit insurance depends on most depositors never truly questioning whether deposit insurance is structurally adequate. The moment enough people begin questioning it seriously, they might move their funds. And if sufficient numbers move funds simultaneously, the FDIC's core function becomes impossible to perform regardless of what the reserve balance shows. This is not a coordinated deception. It is institutional incentive design operating as intended. The FDIC carries a mandate to maintain financial system stability. Maintaining stability requires minimizing public anxiety about stability. The information most likely to generate anxiety, the coverage ratio, the conditional and circumstance-dependent nature of uninsured deposit protection. The political calculations embedded in every significant crisis resolution decision is technically available to the public. It is distributed across quarterly banking profiles, Federal Register notices, and agency staff memoranda. Reading those documents so others do not have to is the kind of work that emerges from years of running a business, surrounded by accountants and financial attorneys who taught what money actually does when it moves through real institutional systems. Here is a practical framework organized across 3 levels because it structures the actual risk in a way that supports useful decision-making. Level 1. A single bank fails. The FDIC has adequate reserves, locates an acquiring institution over a weekend, and the entire matter resolves before it generates significant public attention. This describes the most common outcome throughout banking history: 528 failures between 2008 and 2017. The overwhelming majority resolved this way. Level 2. Multiple large institutions fail simultaneously, or one very large institution fails carrying significant uninsured deposits. The systemic risk exception is invoked. Emergency borrowing is activated. A 48 to 72-hour window of genuine operational uncertainty follows. Most depositors holding balances above $250,000 exist in a legal gray zone during that window. The vast majority eventually receive full recovery, but eventually can mean losing your business, missing payroll, and watching years of operational continuity dissolve. Level 3. The systemic scenario. Multiple simultaneous large-scale failures, borrowing capacity under strain, political hesitation slowing the Treasury backstop,